Between the years 2007 and 2008, we suffered what economists believe to be the worst global financial crisis since the Great Depression in 1930. Particular events occurred that indicated a potential liquidity crisis. One of the leading banks in the world, the BNP Paribas, withdrew from 3 hedge funds that were related to US mortgage debt in August 2007. The failure of Lehman Brothers in September 2008 was another factor of the crisis and put extreme pressure on other financial institutions, so much that banks stopped lending to each other. Nobody knew at this point the scale of the losses, and therefore banks and other investors became very apprehensive when making trades and were forced into reassessing credit risk. A common denominating factor that subsidised the banks becoming bankrupt was that they were going out a nonsensical amount of subprime mortgages in which became default. This was due to the US housing bubble popping, which saw the value of homes plummet. A snowball effect of this was that those who were still able to pay back their mortgage refused to do so because they were paying a value in which their home no longer stood for. As homeowners default their mortgages, collateralized debt obligations failed to reach even their upper and middle tranches, in which investors lost money on what was supposedly safe investment, which caused them to turn away from future trades, leaving banks with houses they cannot sell, therefore incurring frozen credit markets. This problem developed from the banks being incredibly generous in their assessments on these bonds. Banks and institutions all over Europe were also heavily invested into the American mortgage market via these collateralized debt obligations. As a result of being exposed to these loans whilst defaults are rising, European banks also lost investment and considerable amounts of money, this being a prominent factor on the financial crisis spreading to Europe. Deterioration of trading worldwide contributed towards a recession spreading globally. With America and Europe suffering the credit crunch, the demand for exports decreased dramatically. Therefore, countries with economies outside of Europe and the US that rely heavily on exporting goods and services were also severely affected by the financial crisis. It was always thought that the government would intervene if any huge financial firm became under stress and pressure in terms of security. However, the fall of Lehman Brothers proved otherwise. To prevent a domino effect, governments worldwide were injecting huge amounts of liquidity into their banks and institutions. In event of this, government funds towards the private sector were cut, causing mass redundancy. The effect the credit crunch had on the US in terms of GDP was immense during the years 2007 and 2009. The second quarter of 2008 saw the GDP percentage drop into the negative zone, in which signals a recession. This means that there has been a significant decrease in consumer spending, government spending, investment and net exports within the economy. With an extortionate amount of houses on the market, the general value of homes was significantly reduced. This then snowballed into a decrease in housing production because of the huge supply and lack of available demand, meanwhile effectively making labourers all across the US jobless. Bond and stock markets saw their values decrease massively, so much that investors lost confidence in companies and businesses. Ultimately, investors were questioning the solvency of the affected banking institutions and were very hesitant when trading. This was because the investors were very aware of the stress and pressure the banks were under, wherefore engaging in trades with these institutions would be of dangerously high risk. Economists today are striving towards being able to calculate when or if a potential financial crisis is looming and are actively working to mitigate the possibility. This includes in-depth research into the rationality of the decisions we as humans make. Being able to understand how and why we make certain decisions can be a very positive way of preventing future crisis. For example, the irrationality and greed of subprime mortgages led to the 2008 depression. Therefore, gaining information prior to a crisis can aid in preventing it. Workers and families suffer the harsh effects of recession immensely. Therefore, economists today are studying and working closely with the public and the everyday issues that occur, analysing the short and long-term effects of factors such as inflation and employment levels. In doing this, there is potential for economists to understand how GDP can affect a community and the decisions they make. These factors affect the current state of an economy, and therefore acquiring a balance is a necessity. Economists are now working within financial institutions and banks. This is an effort to produce thorough and insightful reports on trading and the risks that follows. This consulting and guidance was lacking in 2008, in which many erroneous decisions were made, resulting in the crisis. Economists are also used within business and firms to develop forecasts and assess the economy of countries they do business and trades with. This is because if they see that the well-being of a country is decreasing, the economist can advise the firm. This inevitably will help prevent high-risk trading and potential future crisis.